Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us today as we take a look at the second in our series of options information where we're going to be discussing, or actually I shouldn't say we, Russell Rhoads with the CBOE will be discussing short option strategies. Now, quickly, I do want to let you know that Russell is a favorite among IB clients in talking about the option contracts. Now, Russell is a CFA as well as an instructor with the Options Institute at the Chicago Board of Options Exchange. He's also a financial author and editor, having contributed to Stocks and Commodities magazine, as well as Technical Analysis. You'll also find that he's edited several books for Wiley Publishing. And in his spare time, Russell also instructs a graduate-level options course at the University of Illinois at Chicago. So we're very pleased to have Russell join us today. Russell, I'm actually going to put this on your slides, pass you the ball. Let's make sure it gets over on your slides. There we go. And I'm going to pass you the ball so that you can get us started. Thanks, Russell, and thank you for joining us.
All right. Thanks a lot, Cynthia. I'm still cracking up a little bit at that spare time thing because I've started teaching at a second college, and I'm starting on a fourth book this weekend. Yeah, all kinds of spare time.
Well, I'm glad that you decided to spend some of that with us this afternoon. Thanks, yeah. Russell.
So, all right. Well, thank you very much for the generous introduction. I really do. I say this just because I work for the CBOE, and we are very broker neutral as we work with several firms on the education side, but in addition, I've been an Interactive Brokers client since like 1999. So I really do like doing webcasts with Interactive Brokers. Just being part of that community for as long as I've been, I really get a kick out of getting to do this once a month. Today, as Cynthia said, we're going to talk about short option strategies, and the plan is over the next, we're 2 months into the year, over the next 12 months, we're going to work through a number of topics. And once a month on a Wednesday around lunchtime, I'm going to start to take it up a notch after this month. We're going to start talking about spread strategies next month. And by the time we reach December, we're going to be on some intermediate topics if all goes to plan. But we're doing this once a month, and I believe that they are being recorded. That's why we took a little pause right at the top of the hour. And so if you're watching short option strategies right now and you want to get up to speed, there's a recording of basic option strategies that should be available on the Interactive Brokers website. Today we're going to talk about just the basics, do a quick review of the basics. I always think that is useful regardless of your level of option knowledge, especially if you're not in there trading options every single day. In my mind, and I know this from personal experience, if there's a strategy I haven't used in some time, I always want to brush up a little bit before I implement it. Trading options is not like riding a bike. It's a consistent process that you need to keep up to speed on, and if you haven't done something for a little while in the option area, it's always good to get back up to speed. Then we're going to talk about buying versus selling options, and today we're talking about selling options. So we've got 3 trades after that that focus in on selling options. The spread trade is going to combine along in a short contract, and the spread trade is actually a precursor to what I will be talking about in March. I'm going to finish up. I didn't really know how to segue this properly, so it will almost be going backwards a little bit toward the end of the presentation, but I do want to talk about time decay and having time on your side. That's one of the nice things about option contracts you can get when you're putting on a short option position or selling an option contract, you can benefit from time decay. And I think it's one of the ways that individuals and non-professional traders can benefit, probably the best way that individuals and non-professional traders can benefit from utilizing options is having time on your side or the passage of time working for you. Now on the basics, you can be a call buyer or a call seller. You can be a put buyer or a put seller, and that's the next slide. But when you buy an option contract, you pay a premium and you take on a right. You get the right to buy 100 shares of a stock at a certain price anytime between now and expiration. On the other side of that, and what we're talking about today, is selling option contracts. And when you sell a call option, you have sold somebody a right, so you have actually taken on an obligation. And in the case of selling a call option, you've taken on the obligation to sell 100 shares of stock at a certain price anytime between now and expiration of that call option, equity call option. On the other side, if you purchase a put option, this is a bearish strategy. If you purchase a put option, you've taken on, or you've acquired the right to sell 100 shares of stock at a certain price. Now, when Cynthia and I were bantering just a little bit, I was talking about taking on a second college class that I've just started teaching last night, just to boggle them a little bit, because we were just talking about what long and short is. I said, just wait until I tell you that you're short a put option, but it's a bullish outlook. And I kind of like saying things in fast and trader speak just to get that glossy look. And then I explain what I'm talking about. And what I was talking about was being a put seller. If you're an equity put seller, you have actually taken on the obligation to buy 100 shares. Now, this is a good way to enter stocks. You can pick a price where you are a willing purchaser of shares of stock, and you can sell a put option and take on the obligation to buy shares at that price. That's actually the put strategy that we're going to talk about today. So when you buy options, again, you pay a premium and you receive a right. Today, again, we are talking about selling options, and when you sell an option, you receive a premium and you take on an obligation. And that's really what we're going to focus on today. And that's get paid, but you get paid to take on an obligation. That's what shorting options is all about. And we've got a font issue. This will probably continue throughout. When you're buying options, you're going to be outright bullish or bearish. One of the other nice pieces to the puzzle here with selling option contracts is you can be bullish, bearish, or you can actually be neutral. And I'll expand on that as we take a look at some of the strategies here. The first strategy, and not just the first strategy I'm talking about today, but the first strategy for anybody out there that's never actually done an option trade before, this is actually the one that I suggest as your first one out of the gate, your initiation to option trading, and it's the covered call. Covered call, you own a stock, and you sell a call option, and when you sell that call option, you take on the obligation to sell your shares at a certain price. Now, if you own 100 shares of XYZ, which is a hypothetical stock, and you are a willing seller at a certain price, instead of putting in a limit order and waiting for that limit to get hit, you can actually sell a call option, take in some premium, and also take on the obligation to sell your shares up at that price, at that strike price. The term covered comes from this third bullet point right here. You've taken on the obligation to sell your shares, and that obligation is actually covered by the long position in the stock, hence the name covered call. Also, do keep in mind that a covered call position is a combination. It's not just the selling the call option. It is the combination of owning the shares and having the short option position on at the same time, having that short call that is covered by your long, being long 100 shares. So for an example here, example of a covered call position. We're long 100 shares of XYZ, which is, don't try to pull up an XYZ quote right now. It's actually what I refer to as a teaching stock, or just one that we're putting up there for educational purposes. Let's say we own 100 shares of XYZ that's trading at 43.5, 43.50, and we feel like we would be a willing seller of our shares of XYZ at 45, and we'd be a willing seller over the next 4 to 5 weeks. Every option trade, and this is a key component here, every option trade has a price outlook and a time outlook. Option contracts do expire. And if you are basing an option trade on some sort of price outlook, you need to make sure that your price outlook comes to fruition between now and expiration. Now, today is February 15th, and March expiration is out at March 16th. So, over the next month, if the stock's above 45 a month from now, we would be a willing seller of our shares at $45. So we sell that call option. And that's the action that we take right there. Sell one XYZ March 45 call. I used a pricing calculator to come up with a premium of $1.15. So let's take a look at what the outcome would be at expiration. And this involves holding the position to expiration. I'm going to show you in a minute. I'll show you a payoff diagram that actually shows what may happen between now and expiration as well. So starting out, when I put these tables together, the first piece that I actually like to put in is what was the result of the trading action? Well, we sold a call option and we took in $1.15. So at every box here in the column under income, I like to put in $1.15. Now we're going to take a look at this first column that already had numbers filled in, $35 through $55 in $5 increments. These are different, just a variety of prices that XYZ could be at expiration. Now before we take a look at the call option, I'm going to take a look at our profit or loss based on just owning XYZ stock. And for instance, if the stock trades up to 45, we'd have a $1.50 profit on our stock. Stock was at 43.5, traded up to 45. If the stock trades down to 40, we have a $3.50 loss on those shares. And you can see subsequently, if the stock price goes down, if you're long a stock and the stock price goes down, you continue to incur losses on that. And if the stock price moves higher on the stock alone, you would actually have a gain. Now let's take a look at the March 45 call. At expiration, the March 45 call is going to have value as long as XYZ is above 45. Now, the tricky piece to this one is we have a short position in this call option. So if there's value in that March 45 call for the owner, if you're long one XYZ March 45 call and you have the right to buy the shares, you have the right to buy a stock that maybe is trading up at 50 for $45 a share. You'll see as I fill this column in, that's $5 of value. However, for us, having a short position in that option contract, for lack of a better term, that's a bad $5 for us, or $5 against us. Now we can sum up these three columns, the profit and loss on the stock, the value of the option contract, which is a negative value for us if it's in the money at expiration. Anywhere from 45 and lower, there's no value in that option contract. And then the income that we took in when we first sold the call option. And the result on the overall covered call position is represented in the final column here, the profit or loss on the position. Note from 45 and higher, we have a maximum potential profit here of $2.65, and that $2.65 is the maximum that we can make off of this position. Above 45, there's value in that short 45 call, and that value offsets the gain that we would have on our long stock position. Now we can put together this table, and when I'm teaching the college kids about options, I always tell them to break out all of the components, and then the next piece that I have them do is I have them draw a payoff diagram. Everybody has to have a ruler in my class. Luckily, I get to draw payoff diagrams using Microsoft Excel, and this is what a payoff diagram looks like for the covered call. And remember, the covered call is a combination of owning 100 shares of XYZ from 43.5 and shorting one of the XYZ March 45 calls. Now the red dotted line that I've put on here is actually the payoff halfway to expiration. We had about 30 days in this option contract. This red line represents the profit or loss based on 15 days until expiration, and it just shows that that you can actually exit the position and take this position off early. It shows where the potential value would be based on some assumptions. But we're going to focus in more on the blue line for our payoffs today. The blue line, again, is what our covered call would look like. And first I'm going to highlight the maximum profit. Maximum profit is $2.65, and our maximum profit on this covered call occurs at any price from 45 and higher. Remember, we were a happy seller of our shares at 45. Now we do have a break-even level of 42.35. That's a little bit better than if we had just held the shares from 43.5. The stock was around where I just put the laser pointer when we considered selling our call option. Again, a maximum profit from our strike price and higher, and a break-even at 42.35 as opposed to 43.5. The downside is if the stock is over here at 55 or so, we have taken on the obligation to sell our shares at a lower price, down at 45. We took on that obligation because the stock at the time was at 43.5, and we were what I'll refer to as a happy seller of our shares at 45. In retrospect, if the stock runs up tremendously and you had your shares called away at 45, you can be content instead of being a happy seller. But when we planned out the trade, we were a happy seller up at 45. Now, two things can happen at expiration, and if the stock's right at 45, either of these may happen based on the decision made by the holders of the option contract. But let's just stick with if the stock's above 45 or below 45. Above 45 at expiration, that option is going to be what we refer to as being assigned. We're going to sell 100 shares of shares of XYZ, and we're going to sell them at 45. They're going to be called away from us at $45 a share. However, we also have that $1.15 of income that we took in when we sold the call option. So our net effective price is $46.15. That $45 and $45 from the shares being called away from us, and the $1.15 that we took in when we took on the obligation to sell our shares. Now, below 45, the option contract expires. We took in $1.15. That income is ours to keep, and the profit or loss is based on where the stock is relative to where it was when we initiated the covered call. So one of two things happens. The option is assigned, and our shares are called away from us, or the option expires, and then we reassess our situation. Maybe if the stock is around 43.5, we take a look at, this was the March contract, maybe we take a look at the April contract if we're still a willing seller at 45 or higher, and sell another call option against our shares. Now the second strategy is what is referred to as a cash secured put. And I'm going to go, I didn't ask permission, but you don't know until you do something if you don't ask permission. The cash secured put is a combination of selling a put option and having the funds to purchase shares. Over the last couple of years, there's an individual that reportedly, and this, the trivia question answer is solely to my discretion here, because it's my question, my answer, and my prize. I'm going to give away a copy of Option Spread Trading, a book that I wrote about a year ago, for the first person that gets this answer correct. Who out there has been the biggest seller of put options with the intent of buying shares over the last few years? There's a fairly well-known investor that has been this guy. And Mary, wow, Mary, she didn't even type. She was so, Mary got it right. Other people are coming in right behind her. Mary's correct. It's Warren Buffett. Mary, my email address, this means you have to stick around to the end of the presentation as well. My email address is at the end of the presentation. Send me your address, and I'll get a copy of my Option Spread Trading book in the mail to you. Thank you for playing. Yes, Warren Buffett, and I'll explain this, and it's a good example of why you would want to consider using a cash secured put. Let's say XYZ is trading at 51.50, and Warren Buffett and his team in Omaha has done all kinds of analysis on XYZ. And they like the company. He understands the company. It fits all that criteria that goes into becoming one of the Berkshire Hathaway family of companies. But he feels like the price that they would like to pay for those shares is $50 a share. So Warren Buffett will take a look at, or Warren Buffett, or people that work for Warren Buffett, will take a look at the put options with a 50 strike and determine if there's enough income to take in to justify taking on the obligation to buy shares of XYZ at 50. Now remember, he's done this analysis. He wants to own XYZ at 50. He is a willing owner of the shares at 50. Let's say that, again, we're looking at last week, same time frame, and he takes a look. He's got his team taking a look at the March options that expire on March 16th. Well, and then he takes a look at the market, and the March 50 put, the XYZ March 50 put, is selling for $1.35. He can take in $1.35 and take on the obligation to buy 100 shares for each contract he sells of XYZ at $50 a share. Now, he wants to own that stock at $50 a share, and he's got the fund. I'm certain he's got the funds to pay $50 a share for 100 shares of XYZ. Now, this is how the payoff would look for this position, again, at March expiration. I always like to start out with the income, or if we had paid for options, we're not buying options today, but if we paid for options, we would actually have red numbers under income. In this case, Berkshire Hathaway has taken in $1.35 for the one March. I'm sure that they would sell a lot more than one, but for the March 50 put that has obligated them to buy shares of XYZ at 50 at March expiration. Now, opposite of a call option, with a put option, there's value in the option contract if the price is below the strike price. At any price below 50, there's value in a 50 strike put. For an owner of the 50 strike put, they have the right to sell the shares at 50. And if you can sell something at 50 that's trading down at 40, that's a pretty darn good trade. However, we're on the other side of that trade. We're short one of those XYZ 50 puts, and we've taken on the obligation to buy the shares at 50. However, remember, we did our analysis. We were a willing owner of shares at 50, and we took in some income to take on that obligation. Now, at any price below 50, we start to feel the impact of the stock being below 50. However, and this is a key. If the stock closes above 50 at expiration, we didn't buy our shares. It was not at that price where we were a willing buyer. However, we get to keep the premium that we took in for that option contract. And that, in this case, that premium is $1.35. Now we'll take a look at another one of those hockey stick-looking payoff diagrams. And this is what the payoff diagram looks like for a short put. We've got our maximum potential profit in this case of $1.35, and then a break-even level down at $48.65. And those of you that can do the quick math, you'll realize that the break-even level is also would be our net effective purchase price if the stock is below 50 at expiration. The motivation, and there are two motivations. Maybe we don't think the stock's going to be below 50, and we just want to sell the put option to take in some income. However, probably a better use for individuals is selling put options where you have a price that you'd be a willing owner. And in this case, we were a willing owner below 50. Now, again, two situations that could possibly occur at expiration. If XYZ is over 50, that option contract expires out of the money, and that $1.35 that we took in to sell it is our profit to keep. And then if XYZ is below 50, this is where some action takes place, we get assigned on that short option contract, and we end up buying 100 shares of XYZ. And as I mentioned on the payoff diagram, our effective price is $48.65. We have the obligation to buy shares at 50, but we got paid $1.35 when we put the position on. Subtracting $1.35 from that strike price of 50 gives us that effective purchase price of $48.65. So now we're going to take it a step further. We're going to take a look at a spread trade where we're buying an option contract and we are selling an option contract. And we're actually going to compare it to a long option position before all is said and done today. And this is, again, I did get one request for a list of the topics we're going to talk about over the next few months. Klaus, send me an email and I'll send you a list of the preliminary topics. It's always subject to change. If something comes up and is very topical, or we get a request to do something a little bit differently, we can always be very responsive to that. But feel free to shoot me an email, and I'll send you at least that topic lines that we have together so far. And next month, we're going to be talking about these very spread trades that I'm getting ready to kind of preview right now. Spread trades can be, we've already taken a look at one spread trade. Spread trade can be that covered call where we own the underlying stock and we sold a call option against the stock. Not only, if that's your first ever option trade, not only have you done an option trade, you've actually now done a spread trade. You have stock and you've sold a call option against it. Spread trades can also involve, in the kind of spread trade that we're getting ready to talk about, can involve owning an option contract and selling another option contract against it. And what we're going to take a look at right now is an outlook that will involve buying an option and selling another option contract. Let's say we've got XYZ down at 37.5 now, and we believe the stock's going to trade up to 40. We think this is going to happen over the next 2 months, and everything had a February 15th date on it. So now we're taking a look at April expiration, which is 2 months off. And with that outlook, we first decide, we got the stock at 37.5, we think it's going to trade up to 40. We decide to buy one of the April 35 calls and pay $4.15 for it. And at the same time, we're going to sell one of the April 40 calls. We're buying a 35 call and selling a 40 call. And when we sell that option, we're going to take in $1.75. And again, this outlook, our price target, where we think the stock's going to be, is right there at 40 at expiration. And the net cost, we use those accounting terms, debit and credit, an awful lot when we start talking about spread trades. In this case, it's a net debit, and it is a cost of $2.40. We can also do spread trades where we actually get paid to put the position on, and that's something we're definitely going to address next month. So the spread trade, we're long an April 35 call, paying $4.15, short an April 40 call, paying out $1.75. Instead of taking in income, again, we've incurred a debit or we've got a cost here, and we're going to fill that cost in of $2.40 at at a variety of XYZ prices at expiration. So then we're going to take a look at each of the option contracts individually. First, we are long one of the 35 calls. At any price above 35, there's going to be some value in that right that we have to buy the stock at 35. And so all the numbers are not red, are good-looking, solid up numbers for us. However, we've also taken on the obligation to sell shares at 40. So above 40, we're going to have some value working against us in that option contract. Notice up at 45, there's $5 of value in that 40 strike call, but that's, again, for lack of a better term, it's a negative $5 for us. And then the result here, it's a pretty interesting potential profit and loss. And this is one of the reasons I'm personally a I'm a big fan of vertical spreads. My job involves, like right now, I'm doing a webinar. I'm not watching what's going on in the markets at all. And that's not a request for somebody to tell me what's going on. That's just to point out that we've all got, most of us have jobs that we're not watching the markets all the time. One of the nice things about vertical spreads will show up right here in this last column. When you put on a vertical spread with the intent to hold it until expiration, you know what your potential loss and you know what your potential profit is going to be as well. Now, you don't have to have a stop order. You're not monitoring anything. You just put the position on with the intent to hold it to expiration. And in this case, our maximum potential loss is $2.40, and our maximum potential gain is $2.60. And this is what the payoff diagram looks like on that guy. And notice, and this is a really interesting piece to the puzzle for vertical spreads, that red line, notice how we really do need to hold this position until expiration. We have an outlook that's very close to expiration to realize the maximum potential profit, especially if you think the stock's going to be right there at 40 at expiration. Notice that we don't even have half the profit booked with the stock at 40 when we've got, I believe that's about 30 days to expiration. I tried to put these dotted lines in at halfway until expiration. So a vertical spread, You have a time outlook, but you have a time outlook that involves where it's going to be at expiration, not necessarily where we're going to go between now and expiration. It's a little bit more, I've heard a term that I like an awful lot for trades like this, surgical. So surgically, we expect the stock to get up there to $40 a share, or maybe a little bit above, and have a maximum profit of $2.60. Our break even was $37.40. Well, where was the stock before we put this trade on? It was actually at $37.50. So it is possible that we could make money on that, make money on the trade, even if the even if the stock didn't move at all. Make 10 cents if the stock didn't move at all between now and expiration. And then our maximum potential loss, if the stock goes in the opposite direction, and if it's at any price below 35, we have a maximum potential loss in this situation of $2.40. Now there are basically three potential outcomes here. If the stock's below 35 at expiration, we're going to end up with both options expiring. We paid $2.40 for this trade, and the premium that we paid for this trade actually turns out to be our maximum potential loss as both options expire. Now between 35 and 40, the long 35 call is in the money, and the 40 call, the short 40 call, actually expires with no value. So whatever value we have in that 35 strike call would be the, once subtracting $2.40 from it, would be our profit or loss. So we might have a partial profit or a partial loss between 35 and 40. And then finally, above 40, both the call and both the 35 strike call and the 40 strike call are in the money, and there's $5 more in value in our long 35 call than in our short 40 call. So the spread is worth $5. We paid $2.40 for something that's worth $5, and the net result is a profit of $2.60. So, and this is why we might consider putting on a spread trade. Again, we had a 2-month outlook for the stock to trade from 37.5 up to 40. If we had just bought the XYZ April 35 call, we would have an 85-cent profit on a $4.15 investment. If we bought the spread at 240, we've got a $2.60 profit on a $2.40 investment. We're taking in some premium. We're offsetting some of the cost of that call option that had a premium of $4.15, and the result's a better return, a better absolute dollar return, but also a better return as far as the use of capital goes. Now, our break even, we actually need the stock to move higher for the April 35 call to make money, whereas the break even was a little bit lower in the case of the spread trade than where the stock was actually trading. And then finally, we're going to give one to the long call here. Remember, our profit was capped at $2.60 on the spread trade. Our profit potential, if XYZ goes on a tear and trades up to $50, $60, $70 over the next 2 months, then we do have an unlimited profit potential. So in exchange for paying less premium and capping our profits, we've got a better potential profit if the stock's at 40 at expiration. However, the profit potential is unlimited if the stock trades continues to trade well beyond our target price, in this case, if we own the call option. So finally, we're going to finish up, and this is another kind of intermediate level topic. We're going to talk about time decay a little bit. In time decay, when you sell an option contract, you benefit from the passage of time. I do feel that this is a good way for individuals to benefit from the option market. Take advantage of having time on your side. All kinds of cheesy things I can say and start making Rolling Stones references, but you want to have you don't want to have time working against you. So, and at the money option contracts experience time decay. They experience time decay in a nonlinear fashion. Let's take a look at how at the money and out of the money option contracts experience time decay. taking an option contract that's at the money and taking I think an option contract that was about 5 points out of the money as well. This is the value for both of these option contracts with 180 days to go till expiration. The big key on this chart is this part over here when you start to look at the end and this almost waterfall type action that occurs with at-the-money option contracts. At-the-money option contracts experience an acceleration in time decay as time passes. And in fact, I'm going to narrow this down to 60 days. You can see that even in the last, let's say I'm going to go over from $1. That red dot there represents the last dollar of value in this option contract. There's $2 of this option contract when we take a look at it at 60 days to go. You really do benefit. You really do get an acceleration of time decay to kick in for at-the-money or near at-the-money option contracts when you're talking about the last 30 to 45 days or so. And if you noted, when I did the covered call position and the cash secured put position, and I used 30 days until expiration, one of the motivations there was this right here, was taking advantage of the increase in time, the acceleration of time decay as we approach expiration. Now, when we're thinking about time decay, there are a few things you always have to keep in mind. If you have a short option position, you are benefiting from the passage of time. If you own an option contract, if there's time value in that option premium, and we're approaching expiration, time decay is going to be working against us. Time is not on our side. The strike price relative to the stock price, how much time we have to expiration, both of those components feed into how time's might be working for us if we put on a short option trade, or how time might be working against us if we buy an option contract. So, just to summarize, and I'll loop back if there's a question or two that I've already seen, but more questions, please throw them into the chat panel. Short option, we receive a premium and we take on an obligation. We benefit from the passage of time by selling a call option. We sell a call option, we've got an obligation to sell shares. So if you own a stock and you have a price where you're a willing seller, short call is it's a good first option trade, as well as a good way to enhance or take in some income in your portfolio. If you've got a stock and if you're Warren Buffett and you've done a whole lot of analysis and you want to buy XYZ down at 50, take a look at the 50 put and consider selling a 50 put, taking in some income and taking on the obligation to buy shares down at $50 a share. You should always take that time decay into account when you're considering a short option position. And then the last, in this, I got a question from Kim. Said, do you take implied volatility into account when you put a position on? Absolutely. And in fact, that goes with this. The reason I didn't answer that question when it popped up was because I knew this bullet point was coming up. Time decay, the time value of an option contract, is directly related to the implied volatility of an option contract. Higher implied volatility means there's more time value in an option. And in high implied volatility situations, I actually, if I'm taking a directional view, I'll actually give more consideration to selling option contracts because there's more premium there. In low implied volatility environments, sometimes it actually does make more sense to purchase an option contract instead of selling an option contract when you have a directional view. So absolutely do take implied volatility into account. I'm going to throw my contact information up here, and then I'm going to answer Mary's question, who was quick on the button with the Warren Buffett answer today. Her question is, do you recommend a stop loss when selling a cash secured put in the event the stock moves quite a bit below your strike? I'll give you a half yes on that. The stop loss would be more of, and I know the Interactive Brokers platform is great for this, the stop loss would be in the form of some sort of alarm that lets me know that the stock has reached a price point. Let's say I was a willing buyer of XYZ at 50, but taking a look at my chart, I feel like it's broken trend if it's below 48. Well, maybe I've got an alarm on my platform that pops up and says, hey, XYZ is below 48, and maybe at that point you consider buying that put option back because your attitude about XYZ would have changed. You're not a buyer anymore. You think the trend has changed from an uptrend to a downtrend. That's just, it's a very basic form of analysis and not a recommendation on how to do an analysis, just maybe one way somebody takes a look at that. The main point there is the stop loss should be based on the stock price. Your entry into the stock should be based on the stock price. Everything that you consider doing within options, the first consideration should be an outlook for the underlying stock price. So that I'll call it an alarm or a mental stop. Mike had a question on the QQQs. Are they good to benefit from time decay because they don't move a lot? Mike, it depends on what type of volatility environment we're in, actually, as far as the implied volatility of the contracts relative to what you think, what the outlook is for the stock or for the QQQs. In general, and I can come up with a few exceptions to this, but in general, the implied volatility for individual stock options is higher than the implied volatility for exchange-traded funds. There's a diversification component to an exchange-traded fund where the exchange-traded funds actually, their movement is netted out relative to the movement in to the type of price movements that we get out of stocks. So usually, trying to benefit from time decay works a little bit better. Not that you can't benefit from time decay when you're trading an exchange-traded fund that represents a basket of stocks, but you generally will do better selling option contracts on individual stocks because more often than not, they have a higher implied volatility than exchange-traded funds. So you can do it in the QQQs. If you have a good handle on how the QQQ trades, selling option contracts is one way that you can go about expressing, or trying to benefit from that outlook. Richard has a question about the IB platform that sometimes I answer the IB platform questions, but I'm not sure about this one. So I'm going to see if Cynthia is lurking around for that question.
I was just lurking and waiting for you to get to that question. Yes, I was. Okay. And actually, Richard, we do not calculate the break-even. If you go in and take a look, you'll see our option trader platform. I also want to mention the risk navigator. Now, that's a more advanced concept, but you may want to take a look at the risk navigator and the different custom scenarios. I do suggest you take a look in the user guide, and because there you'll be able to create those profit plots that Russell was showing you, along with many additional ones, and also play out some different scenarios. So you will be able to see the information within the risk navigator. Unfortunately, it's not something that we calculate on a daily basis. So while it's in there, you do have to do a bit of work for it. So, but I think once you get in and find those custom scenarios, that you will find some additional tools to use with your options strategies.
So, let's see. Selling the QQQ would eliminate the individual stock risk, but not the market risk. Absolutely, Brian. What I was talking about, it was more in lines with the QQQs having generally the options having lower implied volatility than some of the stocks that are the individual components of the QQQ. Again, when you're trying to take advantage of time value is a function of implied volatility, and for the most part, individual stocks have higher implied volatility than the individual exchange-traded funds. So, but yeah, you would selling the you're absolutely right. Brian was just saying selling the QQQ options would eliminate individual stock risk, but not the market risk. You still would have market risk. Theoretically, market risk is a little bit lower than individual stock risk. Individual stocks are typically more volatile than the than instruments that represent an index or the overall market. And I am typing something on the screen right now that I think everybody can see. I just threw my Twitter on there. I keep forgetting to put that at the end of presentations. But
no, we're not seeing it, Russell.
You're not?
No.
Oh,
you'll have to put it in. Ah, there it is. Now
okay.
we see it.
There it
okay.
is. So,
there it is.
I've been, whenever I write new articles or am going out, I'll be in the next few weeks, I'll be in San Francisco, New York, Atlanta, and Kalamazoo, Michigan. I like that last one. So I like to tweet when I'm going places in case there are people that have seen me on webinars that would like to meet in person. So there you go.
Well, Russell, what I'd like to do, you see I've just grabbed the ball back from you. There were a couple of questions about the upcoming events, so I want to make sure that everyone knows where you can actually access that. Now, notice your screen, and Klaus, good, I'm glad you're still with us because you had a question here earlier about the upcoming events. Now, you'll notice I've just brought you, we're doing a desktop share, and I've brought you to the Interactive Brokers website. Now, notice if you go underneath the Education menu, there's a webinars link here. And then simply take a look at our live webinars. We've got all of these are already scheduled throughout the year, so you can actually sign up for them today and get those reminder notices as we get closer to each event. Now notice here, I'm going to go to the Industry Sponsored tab, and you'll see today's event is currently listed. And notice as well, as we get closer to the event and we do get the presentation, we will post the webinar notes that Russell provides. So these are accessible as you sign up for each event, or it's also will appear this afternoon as you exit today's event as well. But notice if I come up and filter by, I'm just going to go into our sponsors here and take a look at the CBOE. Now notice when I tab out of that field, as I continue to scroll down, you'll see next month in March, we're going to take a look at bullish spreads, then bearish spreads, those neutral strategies. And notice here that each date, and for the most part, what we've been trying to do is schedule these on the Wednesday that precedes Option Expiration Friday. So another way that you can remember. Now notice there is a link to register here, so if you're interested in any of these topics, here's the topic, the description, and the registration link included. Now I'm going to jump up to the top of the page because if you joined us and didn't attend last month's event, you can also catch up on that. Notice at the top of this page, there's the watch the previously recorded events. And again, I'm simply going to go into our CBOE, and notice here is last month's introduction to options. So all of these will be listed, but also notice we've got quite a few additional topics that Russell has already provided for us. All of these are available 24/7, and don't forget the webinar notes that are also included here. So if you want to catch up on this or our 2012 series, simply go out and check the introduction to options. So did want to make sure that everyone had seen that. So let me actually take us back into the event session. I see Kime is looking for a session for advanced option traders. Well, actually, Russell and I have already discussed that. So as topics do come up, that we will add additional webinars throughout the next year if there is a topic of interest. And speaking of which, what I would like to do, so thank you, Kime, but you'll notice I'm going to open up a polling panel on your screen. IB's management asks that I run this in each event to make sure that we are delivering relevant information. But you'll also notice that there's an input field in question number 2. So Kime or anyone else in the event, if there are other topics that you'd like to see covered, we think Russell is a terrific presenter. So we will discuss this with Russell at a and see if we can put together an event that will cover some of those more advanced strategies. By the way, Kime, don't forget our webinar archives. I think you may find some very interesting topics there as well. Poll's about to end, so if everyone would click submit now, I'll be able to capture those results. Thanks, everyone. And by the way, if you still have questions for Russell, go ahead and enter them into the chat panel. You'll notice the chat panel may have collapsed, if you can see that title bar, simply double-click, and that will reestablish the chat panel for any of those questions. Okay. Well, I'm not seeing anything additional come in right now, so it looks like we are going to wrap up today's event. Russell, thank you very much. A very informative session today.
All right, thanks a lot for having me. I always, I'm not just saying that when I start out. I really do like being associated with you guys. So.
Well, and we certainly enjoy the information that you're passing along, so thank you very much. By the way, everyone, all of the information does appear in the PDF copy that will pop up on your screen as you exit today's event. So thank you all for your participation here. Be on the lookout for the recorded playback if you want to come back and review those concepts whenever it's convenient for you. So thanks, everyone. Have a great afternoon. And remember, trade smart.